First of all, this is what Warren Buffett, the world's greatest investor, has to say about margin of safety. We believe this margin of safety principle, so strongly emphasized by Ben Graham, to be the cornerstone of investment success. So, margin of safety is a term that you may have come across already in financial circles, but it actually has its roots in engineering and quality control. Essentially, it's a method used to reduce the chance of a process or a system failing. The best way to see margin of safety in action is with the concept of a bridge. Imagine you're asked to build a bridge and you calculate that the weight that it needs to support based on estimated traffic levels is 10,000 tons of vehicle at any one time. You could feasibly design a bridge that supports 10,001 tons or even 11,000 tons. That should hold when traffic is flowing over. But what if the estimates are wrong? And what if something unexpected happens to the materials or to the traffic or to the bridge itself? It's for this reason that engineers always use a safety factor. So instead of designing a bridge that supports 10,000 tons, you're going to design a bridge that supports 30,000 or 40,000 tons. That bridge is going to be much harder to break, and for a long time it will be much safer to drive across. Margin of safety is also very important in stock investing. So much so that Warren Buffett calls margin of safety the cornerstone of investment success. The idea is to work out what you think a stock may be worth and only invest if the purchase price is significantly lower than your calculation of value. This gives you a cushion to allow for human error, bad luck, or unpredictable volatility. For example, it makes no sense to buy a stock for $60 that you think is only worth $62. That only gives you a very small margin of safety and consequently a large margin for error. Much better to find a stock where the margin of safety is 30%, 50%, or even more. For another example, let's say you like Apple and you calculate that Apple stock is worth around $130 a share. And let's say that the current market price is $111. To achieve a 30% margin of safety, you need the stock to drop to $91 before you can think about buying it. For a 50% margin of safety, you're going to wait patiently and wait for the stock to drop to $65 a share. So as you can see, even though you think the stock is currently trading below its true intrinsic value, you're not going to buy it until it's on offer at a much bigger bargain. If you can learn to apply the concept of margin of safety to all of your investment decisions, you're going to be limiting your potential downside, limiting your risk, but giving yourself much more room for upside.